All right, hey guys, it's Erica Osborne here with the Think Real Estate team, and I had a couple investors ask me some detailed insurance questions, and that's not my field, but I know people whose field it is. And today with me, I have Janet McCaskey with McCaskey and Associates Insurance Agency, because she is my go-to gal here in Hampton Roads for anything associated with insurance. So thanks for being with us today, Janet.
Thanks, Erica. It's great to be here.
All right, and so we're gonna break this up into three sections, and we're gonna start here with the general insurance questions. So we'll go general for our first clump for this. We're gonna go investor related questions for our second clump, and then we're gonna go flood for our third clump. So first, we're gonna touch on general, and we're just gonna start up at the top, and then Janet, again, anything you think will be of value to everybody, please pop it in outside of my questions.
Absolutely.
But the first question.
Sure.
You are about to close on a property and you need insurance. What type of information does an investor or a homeowner need to give you in order to get the ball rolling and receive a quote?
Well, it's always great to give as much notice as you possibly can. It's really difficult, especially with lending right now. They're wanting much more time between having all the documents and your closing date. So as much time as possible, if you can, if you know you're not closing till 30 days out, go ahead and get it in place. It's better for you. But as far as most information, we're going to need a name, obviously, date of birth, social, a mailing address, which in the fact of a homeowner's could be the same address as they're purchasing. For an investor, obviously, we would need a separate mailing address. In an investor standpoint, there might be an LLC involved or an corporation involved. We would need the information on that, a tax ID as well, and then just phone number, email, basic contact information from there. And there would be more specific questions based on each property.
About how long would it take to receive a quote?
Generally, I will tell you 24 to 48 hours, depending. If you call me at 5 o'clock on Friday night, it's probably going to be Monday. But I can turn them around pretty quick. A lot of times if it's the same day, if you call me in the morning, I can usually have it to you by 5 in the afternoon. So I have done them where they're sitting at the closing table and it's in complete total rush, for whatever reason, their current deal fell through. And I have put it in place in under 30 minutes, which I don't like to do. Things fall through the cracks, and I just want to make sure that I give you the correct information.
All right, and I realized that I completely, I just totally bulldozed through. Can you tell us a little bit about about you, Janet, where you're from, how long you've been in the area, how long you've been in insurance? I'm so sorry that I bulldozed right through.
Not a problem. I have been here for 20 years. My husband's a retired Navy, so that's how we got here. I've been in the insurance industry, 17 years now. I was a captive agent for almost 10 years and decided to open an independent agency. It'll be 7 years ago in August. Been doing my own thing. So I'm a broker. So what that means is I have no loyalty to any particular company. Like State Farm wants to go State Farm, Allstate goes Allstate. I just look for the best deal for the client. So I have no loyalty to any particular company. Depending on what you need, I have about 30 different carriers that do a gamut of auto, home, flood, small business, a little bit of everything. So live here in Chesapeake, been here for 20 years. So just love what I do.
Obviously.
So I'm sorry, what'd you say?
I'll plan on sticking around, obviously.
Obviously, yes. So we've got roots here. My husband's retired, has a job. So my turn to have a place to stay for a while, and he can just stay here instead of me moving around a lot. And all those Navy people understand the moving. So
yeah. All right. You come from a good vantage point of people moving around, people needing homes, the transaction of it all. So that's awesome.
It's really great. I've actually done a lot of deals where people have seen the houses sight unseen because they're moving in from Italy or Japan or Germany, and they've just done a virtual tour with their realtor. So yeah, it gives a great advantage. I'm used to working with people via email, so it's not a problem.
And it's always nice to have a connection with with somebody who's related to the local industry, the Navy. So
that's true.
You can sympathize, you can empathize, you can put yourself in, right in their shoes, having to have bounced around yourself. So
that's true. So.
All right, Janet. All right, sorry about that. Now
that's quite all right.
Thank you for sharing with us, of course. All right, so we're talking about policies. So we talked about what somebody needs to provide for you. So now, is there a difference between a policy for a single family home versus a condo or a townhome?
It depends, and that sounds kind of weird. Virginia Beach has a lot of times they'll list things as a condo, but it's actually as a homeowner. So it really comes down to the documents that we would need. A homeowner's in a townhouse is going to be on a home paper, which is called an HO3. A condo is traditionally an HO6. The difference between that, if there is a master policy with a condo, you're only required to cover the condominium from the studs in. So you would have the wiring, drywall, carpeting, floors, walls, divisions, cabinetry, that kind of thing that needs to be covered. Versus in the homeowners, you're going to be responsible for all that and the exterior as well, being the siding and the roof.
So does that typically make a condo policy less expensive than a single family policy?
It can, but location, location, location. So, and it really just depends on, I mean, you've seen some very upscale condos. I think I've had one that was close to $1 million. I mean, it's just, you know, it just depends on what it is. And also a condo is driven by contents a lot of times as well. So, you know, if you need more contents than someone else does, that's going to drive the premium as well.
All right, awesome. All right, so is it better, this is a specific question.
Okay.
That I actually have. Is it better to have a higher deductible and a lower premium, or a higher premium and a lower deductible, in your opinion, and why?
Okay. I want to add one little thing before we go into that is credit score is going to be a big part of how much you're paying for your premiums. So if you have a lesser credit score, your premiums are going to be higher regardless. So that's just something to take into account. But as far as deductibles go, I usually don't recommend someone make a claim unless it's a couple of times the deductible. So if you have a $1,000 deductible and it's going to cost you $1,500 to fix it, I generally tell you to go ahead and just take care of yourself. The reason being, you're going to get about a 20 to 25% surcharge for the next 3 years for that claim. So you want to make sure that that's going to equal out what your increase is going to be of what you're actually collecting. So as far as the deductible is concerned, I usually tell people, Erica, if I needed your $1,000 today, could you do that? And then I go, if it's $2,500, could you do that? Now that might be a credit card, a loan from your grandma, whatever, but could you come up with that money right now, right this very moment? And most people can answer that pretty comfortably. Like, I'm not saying you want to do it. I'm saying, could you do it? So most people are pretty comfortable around the $1,000 deductible. So that's pretty average in this area. Obviously, we have separate wind, hail, hurricane deductibles, depending on the carrier. And that's another thing you need to read the nuances of it. There's actually a wind deductible, a named storm deductible, and a hurricane deductible. And there are 3 different things. So that's also going to play into your premium as well. A wind deductible is going to be more on you because your wind is wind. If that's a 30-mile-an-hour gust and you lose your roof, you're going to get that wind deductible. Whereas if it's wind, but you have a hurricane deductible, you're going to fall under that $1,000 deductible. So it's really good to know which one do you have and which one you're going to be obligated to. And again, that's going to come back down to what do you feel comfortable with today if I need that down. So it's a personal conversation for everybody.
All right. Now, and do those deductibles, are they different? I know in Florida, we used to see like 1% hurricane deductible or something of that nature, where it was 1% of the replacement cost would be, or something of that nature. Like, is that how the deductibles on each of those separate pieces run up here? Or because there's all perils, right?
Correct.
And you have the wind, wind hail is at least what they had it, and then it goes to hurricane.
So
right?
wind, hail, named storm, or hurricane is going to be a percent. Let's just assume it's 1% for the sake of the conversation. That 1% is your coverage A amount, not of the claim. A lot of people think it's 1% of the claim amount. It's 1% of your coverage. So if your dwelling's insured for $250,000, 1%, you're going to have a $2,500 deductible. So it just really depends on, again, the company. Some companies will be a little higher, some will be a little lower. Location's going to drive that decision. Some of them are not. I have some carriers, they're mandatory 5% wind in Virginia Beach. I have some that are mandatory 1%. So it just really depends on the carrier and the premium. So it's just a triage game of seeing what's the best fit.
Awesome. All right. Can you get different lengths of policies? And this is probably a question more so down in the investor, in the investor nugget, but I popped it up here in the general nugget. But can you get different lengths of policies?
Yes, you can. On the homeowners, it's a 12-month policy.
Okay.
So that's pretty standard. Same with renter's insurance, it's a 12-month policy, but you're not married to it. You can cancel it during the year. So let's say 6 months in, you found a great premium and you want to move to another company, you can do that. There's a lot of hoops to jump through, but it can be done. But you really are going to see the term given to the investor side, especially when they're doing a builder's risk policy. We have terms as short as 3 months, 6 months, 9 months, 12 months. And then after that, it's just a renewal of the 12 months if you needed an additional 12, or you could renew a 6 month, or you could renew a 3 month. I see that a lot with the rehab properties.
And can the length of the term, does that determine the amount of it? Meaning, like, if you were to get a longer period of time, is the per month cost, is it going to be a lesser cost? Does that make sense? Let me see if I can say it.
Sometimes, but sometimes buying in bulk is a little cheaper. It's kind of like going to Costco. You know, if you buy
Yes.
in bulk, you're going to get that better price tag. So it really just depends. Like a 3-month builder's risk policy is what we call fully earned. So if that policy is $500 and you don't need it but for 2 months, but you wrote it for 3, you're not going to get any money back. So when you get into the 6 months, you can actually get some prorated premium back. So generally when I'm working with my investors, I'll get them to go a 6-month, 9-month, 12-month. And sometimes it's also going to depend on the lender. The lender, even though your project may take 3 months, they're going to want to see a 12-month policy put in place. And again, that goes back to getting a refund of premium if you sell the property or convert it over to a landlord at that point. So, but homeowners are pretty standard. They're going to be escrowed through the homeowner, so they're going to be a 12-month policy.
Awesome. All right. And you touched on this earlier. Is it true that claims made against policies haunt you forever? And you touched on how long they haunt you for and what they do. Can you say that again?
Absolutely. Yes, claims will affect your premium. My average, and this is not written in stone, it's just something that I've noticed over the course of seeing claims. They haunt you for 3 years. So if you pack your bags from here and had a claim and go to California, that claim's going to follow you, not the house. So if you go to buy in California, now you're going to have a homeowner's claim on there, and it's for 3 years that they're going to see that. And they could ask for more information. You know, a lot of times if it's a catastrophic claim, like if we have a hurricane come through, they won't penalize you for it. It'll still show up on your report. I can also see claims that were made on the house. Let's say you're purchasing 123 Main Street. I can pull it up and I can see if any claims were ever made on that house that you may not be aware of. So I could give you a heads up of, hey, Erica, you're doing your home inspection. I see we had a $5,000 water claim. You might want to make sure that all the repairs have been done. So it's a little bit of a heads up that I can see coming at you. But you're not penalized for a claim that wasn't yours. The claim's going to follow the person.
All right. All right. So this is a specific question from an investor.
Okay.
So why is there such a difference in premiums between carriers, and what are the causes of some of those differences?
Claims are going to be the #1 reason. So what carrier has experienced more claims in a particular area versus not. So that's going to be the big driver. Credit score is going to drive it. We already talked about that. So that's going to be one that's very specific to the person. And, length of ownership is going to come into play. Every carrier has their own loss ratio, just like you have, your own sales goals. They have their sales goals, but they're also looking at their loss ratios on the backside. If they sell $1 million, but their loss ratio is 750,000, you're going to see more rate versus the other way around. So it really just depends on the carrier and what carrier you go with. A lot of my investors choose to go with higher deductibles because they'll take care of the little stuff. They're not looking, the HVAC conks out, they'll just replace it. They're not worried about it. So it really just depends on what you've done with it. Like I said, claims history, credit scoring, and the losses that are associated with that particular carrier are going to drive the rate.
So would you say then that, if you're presenting an investor with some options for their policy, do you present a couple different companies? Because, some are going to look a little different than others based on, like you said, the stuff that they have going on, their loss ratios. Is that right?
Right. Traditionally, I just shop for the best rate. If they want to see the top 2 or 3, I'll give them the top 2 or 3, but generally I'll just present the top quote. I make it, apples to apples to each carrier. So if I'm quoting 200,000 to this carrier, I'm going to quote that across the board. So that is not going to be a variance of change in that aspect. So if they want them, yes, I can definitely give them to them. And again, it depends on the product, where it's located. If you're within 5 miles of the ocean, it's going to knock out half the carriers. So it just depends on location again and what you're looking for, that it might cause a reason for premiums to be more versus not.
But in reality, because you're comparing apples to apples, it's going to be very evident who wins out on the rates, like you said, and so you
Exactly.
would pick the best rate.
And I do have a couple carriers that don't credit rate score that hard. So if your credit is a little challenged, that might be a good fit for us to look at. So again, it just really depends on, each one is triaged differently. So they're looked at very separately.
Does it ding your credit as an inquiry when you go to?
It does not. We get asked that a lot. It is a soft inquiry. You will see it if you look to see if anyone's ever inquired about your credit score, but it is not a hard hit. Now, if you went through and did, 75 different companies, yeah, you're probably going to see a percent or two difference. But traditionally, they know that you're purchasing a home. They've already seen the mortgage get pulled, so they know you're shopping for insurance. So it's a soft inquiry. So you would see that, but it does not affect your credit score.
All right. All right. So one last question, and again, you touched on this at the beginning because
Sure.
you're so thorough, and my questions bounce around. How many days out before closing should you have your policy ready to rock?
Absolutely start shopping it as soon as possible. It's a lot of information can be found out, and I can give sometimes the realtor a heads up. I'll give you an example. I had one that was 45 days out from closing, and I'm like, wow, they're really shopping early. But come to find out, I started doing my research, and the roof was over 25 years old, and I couldn't find a carrier that would insure the home because the roof was too old. The realtor actually went back, negotiated, got them a new roof, and I got them a killer rate. So it really just depends. I mean, as soon as possible is always my best advice, because the closing date traditionally will change 3 or 4 times. Even if you're 30, 45 days out, it's going to change a few times. So as much information as you can get, go ahead and start early. Why wait?
But worst case scenario, something happens, you can make it happen pretty darn quick.
Yes.
Who
Try
likes
not to. Don't do
that?
that. Shop early.
Nobody likes to have to
Don't be the last minute Christmas shopper, okay? Don't be my husband and go out on Christmas Eve and then wonder why there's nothing left for you, okay? Go ahead and shop early, get it taken care of. And it just gives you the opportunity to, if you're not happy with the quote, to look at another option. I mean, there's great companies out there. I really don't have anything bad to say about anyone, but does it fit what you need is all it comes down to.
And typically when you go and quote, that policy is going to be paid when you close on the property, correct? Or do people have to pay it upfront before outside of closing?
Okay, that would really depend on if it's an investor doing a cash deal versus an escrowed account. So if it's escrowed, and either way, I can really send the invoice to closing that can be paid at that point. I have some investors that they need to have a paid receipt versus paying it at closing. So that's a little bit different on the investor side. But for homeowners, yep, no, they'll do the check at closing and mail it to me. I generally get it about 10 business days after you close. I'll get payment on the policy.
All right, awesome. Okay, so that ends we're doing pretty well on time, Janet. I'm impressed. That ends our general section. So we're going to close on out here and come back with our investor section. So see you guys in a little bit.